Good morning, everybody. Before we actually get into the formal business this morning, I'd like to acknowledge that this is Zubair Limbada's last meeting, as we shall be welcoming a new university representative in the summer. I'd like to take the opportunity to thank Zubair for his presence over the past 6 years, and I've greatly valued his contribution at both the local pension committee and the investment subcommittee meeting. I'm sure you'll all join with me in wishing him well. And who knows, we may see him another time. You never know. Right. So, welcome to today's meeting of the investment subcommittee, which is taking place at County Hall in Glenfield. This meeting will be broadcast live via the County Council website and will also be available for viewing after the meeting. Can everyone please remember to switch their microphones on when speaking and turn it off when you've finished? So the first item on the agenda today is the minutes of the meeting held on the 11th of October 2023. I propose that the minutes of the meeting held on the 11th of October are taken as read, confirmed and signed. Is everybody in agreement? Yep. Okay. We now move on to agenda item 2, which is question time, and I've received no questions. Agenda item 3, questions asked by members under Standing Order 7.3 and 7.5. We received no questions. Agenda item 4, to advise of any other items which the chairman has decided to take as urgent elsewhere on the agenda. I have not been notified of any urgent items. Agenda item 5, declarations in respect of an interest on any items on the agenda. Does any member have any interest to declare? No. Okay. So the first substantive item is the cash position as at the 31st of March 2023 and forecast for the year ending 24-25. Bullish, Senior Financial Analyst, will introduce the report. So, Bullish, over to you, please.
Thank you, Chair. The purpose of the report is to update the subcommittee on the cash holding of the fund and its plan for deployment against the strategic asset allocation as approved at the last local pension committee meeting in January. So it's a fairly standard report that we see every quarter at the subcommittee. Just a bit of background, the cash balances are reported to the local pension committee alongside the fund investment values each quarter. At the last update presented to the local pension committee on the 8th of March, the cash balance stood at 421 million, with another 48 million with the fund's currency hedging manager. So that's as at the 31st of December snapshot. Aegon, who is the fund's currency hedging manager, keeps a bit of collateral just to support the currency hedge. And the fund does not have a specific cash allocation as part of its strategic asset allocation, other than to set a limit of 0.75% of total fund assets to reflect the cash that Aegon holds to support the currency hedge. As a result of making changes to lower the equity holdings towards the 37.5% of total fund assets as approved at the January 2023 local pension committee meeting, the fund has held high levels of cash through the year, and that's through 2023, and as such set up a cash management strategy which was approved at the ISC in October 2023. Just a bit of background on the cash management strategy and an update. The cash management strategy contains a number of allowable investment products together with maximum terms and maximum sums that can be invested into either single products or investment classes such as money market funds. The main change since that October meeting at the ISC was to set up 3 additional money market funds with a max limit of 50 million in each per the strategy. As at the 31st of March 2024, the fund has access to 4 money market funds now, into which 118 million in total was invested at the year end. And that's of that 328 million. Of that 328 million at the end of March 2024. The fund does also utilise term deposits. The cash management strategy allows for investments with maturities up to 1 year for both. And as at the year end, the fund had a combined 210 million invested into fixed term products. So that's the combination of the money market funds 118 and 210 million into fixed terms is the 328 in total as at the year end. Of note, at point 10 is at the financial year end, the fund is in adherence to that cash management strategy. And you've got the table there at point 10 that shows all the allowable types of investments. Moving on to point 12, cash holdings as at March, as mentioned earlier, 328 million in cash. It is forecast to reduce over the course of this calendar year, and it's currently expected to be around 250 by the end of 2024. So still substantial, but reducing over time, and we'll come on to the reasons why later in the paper. Owing to the positive nature of the fund, so we collect more in contributions than we pay out in pensions. Unless we're reinvesting all the time, the balance does grow. However, with interest rates being elevated in comparison to the period from 2009 to 2022, the fund has been receiving interest payments on average in excess of 5% through the 2023-2024 financial year. And as at the time of writing this paper, middle of April, the weighted average interest rate on term deposits is 5.25, and the rates on the four money market funds range between 5.1 and 5.3. A quick recap of our strategic asset allocation is at point 17. That was the allocation that was approved at the January 2024 Investment Subcommittee. You'll note that we've got a number of columns on that table there. We've got the 2022 strategic asset allocation, and then we've got the 2023 and 2024 together on the basis that the weightings weren't changed. So you've got the final column in there showing you the main changes from the 2022 allocations. Point 18 looks at the changes in the table in 17. The main changes were from that 2022 allocation to the 2023-24, a reduction to listed equity, so that's quite substantial, a minus 4.5%. An increase to infrastructure plus 2.75%, and an increase to liquid global credit plus 5%. So they were the main changes, and they've taken an amount of time to get through, and we'll come on to those next. So how are we doing in terms of aligning to that 2024 allocation is described on the table at point 18. You can see on the last but one column in that table the difference to this 2024 strategic asset allocation. And what you'll notice there is that we have an overweight in the top section, which is classed as growth assets, and that's 3.2% over on the listed equity. And we have underweights across the income asset classes. So that's minus 1.8% in infrastructure, minus 2.1% at global credit, minus 2.9% at property, and a minus 5.3% for liquid MAC, multi-asset credit. I'll just run through some of those big ones in more detail. So at point 19, listed equity, which is the 3.2 overweight. What have we done to get towards that 2024 allocation? So we're divesting from the LGPS Central Active Emerging Equity Fund, so that will reduce our overweight. We are going to add to the LGPS Central Active Global Equity Fund, and we're divesting from a Legal and General All World Equity Fund, and all of those are planned to occur during the remainder of this year to bring us back to that 37.5% target. What it will do is it will add an amount of cash. We could have enacted these earlier, but it would already add to our substantial cash balances, so we've left that overweight for now. And the reason for that is we just can't get it away into the areas which are underweight, which are illiquid and a reliance on managers asking for the cash when they need it. Infrastructure, for example, it's underweight by about 100 million at the time of writing, but we do have 170 million in uncalled commitments, so the instructions have been placed. The global credit private debt underweight by about 130, but exactly like infrastructure, we have around 210 million in uncalled commitments. Property, we're about 175 underweight. A couple of things here. Due to the poorer performance of the property market, compared to other asset classes, the valuation will mean that we're further away. At the same time, we were waiting for an LGPS Central product to be set up. So until that was set up, we couldn't allocate any money to that. The underweight, however, will have been reduced by about 20 million since the 31st of December snapshot. The LGPS Central's direct property fund has called for at least that much. In addition, we've got another 50 million uncalled, and it's in the process of being called by the LaSalle Property Fund. Liquid MAC, multi-asset credit. So this is one that isn't dependent on managers calling money, and we have been adding to that since the end of December. 2 separate investments have been made so far in 2024, totaling 120, and we've got planned investments at regular intervals through 2024. So that'll take us to 9% of total fund assets, which is the target for that one. So during the year, we will have added 300 million to this one product. Emerging market debt. This is the last one within that income group, and it's an overweight. And the plan here is to totally divest in line with the strategy from this asset class, given that we have an allocation to emerging market debt within the multi-asset credit. It simplifies our holdings slightly. Outstanding calls at point 20. Just so you know, that we do have about 400 million on that table there of cash as at the end of December. We do have outstanding calls of over 600 million to managers, which will need satisfying over the coming years. Much of that is to products managed by LGPS Central. About 380 million of that 600 will be called by various products from Central. Point 22 is an update here on the private credit approval. The fund has got 2 outstanding private credit approvals made at the July 2023 meeting of the subcommittee. 22A and B is the 180 to the low return sleeve and the 100 million to the real asset sleeve. Both of those are on hold at the minute while the LGPS Central replace a key member of staff and finalise the mandates, including legal docs. We are in regular contact with developments at LGPS Central on those bases, and if officers aren't satisfied with the progress, then alternative options will be investigated with the fund's investment consultant, Hymans. Happy to take any questions.
Thanks very much, Bullis. So that's a fairly comprehensive run through. Has anybody got any queries or questions? Anybody? Yeah.
So, mine is probably a very basic question, which you might expect from me. How are weightings arrived at?
So this is the annual process where we set up some work with Hymans Robertson well in advance. It gets taken to it gets taken to every January's local pension committee meeting. Hymans Robertson come and present. We haven't had a change over the last couple of years. We've been fairly happy with our steady state for our allocations, but they can be tweaked year on year, but it's on the advice of our investment consultant.
So, Subir.
Thank you. A couple of points. On the term deposits, I'm assuming there aren't any, but just to confirm, are there any term deposits with overseas banks?
So we utilise a list from our Treasury advisor. There will be overseas banks on that list. I couldn't tell you at this stage. We probably have more than a dozen term deposits. I couldn't tell you at the minute if there is an overseas bank on that list that we've invested with, but they are all approved banks from our Treasury advisor. They do a lot of risk management based on credit default swaps, etc. And so it is an approved list. It's not something that officers, choose.
Just to add to that, we're only obviously lending in sterling, so it does tend to be kind of only people who are interested who've got sort of operations in the UK. So anybody we lend to on that approved list has got branches in the UK as opposed to kind of actually lending on international markets.
And the second question was, what's the maximum counterparty limit for term deposits?
Take the glasses back on.
I think the money market fund is 50 million. In each money market fund, but
so we've got a total of 250 million for term deposits, and yeah, we've got a total of 250.
That is the counterparty limit.
Yeah, for term deposits. Yeah.
Okay. Thank you. So,
okay. Yeah, that's the total amount. Yeah.
Okay.
On an individual institution.
On an individual basis. Yeah.
I'll have to get back to you on the individual institution. But I know from our own current holdings, we don't have anything more than 50 with an individual, but we've got substantially less in some cases, 10s and 20s.
That's right. It's a 50 that's capped per bank.
Yeah, it doesn't say 50 in. Yeah, but we've got 50 for the money market fund.
Yes.
Yeah.
Yes.
Sorry, was that the original question?
No, it's the
term.
Similar question for the term deposit. Yeah.
I can get back to you on that.
Okay. Thank you.
Okay. Thanks a bit. So, David, did you have a question?
Yeah, just looking at items 14 and 15, I take it really that we're we're taking advantage of the high interest that's on offer now. We're pinning down funds to those high rates. Is an obvious question that presumably we are taking advantage of the current situation out there.
Yeah. So, we're fortunate. We're at a point where the fund holds quite a lot of cash and interest rates are relatively high, and we're not choosing. Do we think rates go up or down? So we're hedging our bets. We've got some money in money market funds which are liquid and rates change daily, and we've got some money which is fixed and therefore is fixed for the duration of that term. So we've fixed anywhere between 3 and 9 months generally. So
expecting rates to go up any further, are you?
We're not making a call on that either way. We've got some money that sits in money market funds. So 118 million at the year end was in money market funds, which is daily changing prices for rates. And we've got 210 million in fixed rates, which obviously we're fixed at the point of making the deposit. So we're not making a decision on which way things would work.
Okay, so any more questions or queries? Adam, yeah.
Question around benchmarking. Is there a formal kind of benchmarking process, kind of metrics that you'd look at across to other funds, etc.? I know you look at a fund, our fund as an individual fund, but I guess you must track performance. And how formal is that?
So our fund tracks its own performance against the benchmarks of the individual investments it makes. So, for example, if we were to invest in a global equity product, it would be benchmarked against a global equity benchmark. No, we don't formally do that. Only because some of the risks we take are different to the risks another fund takes. If we have 30% in equity versus a fund that has 60% weighting in equity, we'd expect their returns to be higher. It's just a risk you take. So we don't formally benchmark externally to other funds.
Okay, thank you. So if there's no other, Subir.
Apologies. I know it's not about the strategic asset allocation on this paper, but just noting the table as a paragraph 19. Is it 19? I think 18. Just looking at the allocation, and now it's overweight on growth assets. Just currently where the markets happen to be at the moment. Instinctively, you would think it's probably not a problem to leave it overweight for now. I'm just saying as a layperson, but is that something which, instinctively you think actually is probably okay, because this is the time to make hay while the sun's shining, so to speak. And then, hopefully gradually over time, you've got more flexibility to move. But markets don't work that way. But you're just thinking, is it okay to probably leave it overweight in growth assets for now when markets are doing so well? It may be short-lived in terms of.
I'll answer the first part of that. I think Philip wants to step in for the second half, by the sounds of it, looking over this way. So ideally, we'd go straight to the target allocation. That's what's been approved by committee, and that's what we want to manage to. At the minute, we just can't get the money into the areas which are underweight, which are the illiquid parts. We're reliant on managers calling that money, even though the commitments have been made. So although we could take the listed equity component down to 37.5, we'd be sitting on 421 million plus another 200 million in cash. And again, we don't have an allocation for cash. That's supposed to be zero. So again, we're not going all the way over. Going back to your original question in terms of where equity markets are and whether or not being overweight's relevant, maybe one for Philip.
Sure, thank you, Bullish. I mean, the things that I wanted to say were, firstly, we're very much investing for the very long term, and with that mindset, you have clear targets of allocations. It is generally recognised that it's a good idea to regularly rebalance your actual allocations to those targets to make sure that there aren't huge overweights or underweights. And there is evidence that shows that over time, that if you do that, you earn more return than if you just let the actual asset allocations drift where they will. Having said all that, we do keep an eye on the short-term outlook, the 1 to 2 year outlook for all the asset classes, including equities. And if you were running a very large overweight to, let's say, equities, and we had an extremely negative view on equities over the next 1 to 2 years, we would say to you, look, you really should rebalance and do whatever it takes to close that equity overweight, because equities look as though they're going to have a horrid time. That's not the case currently. Our view on equities is neutral. There are reasons to be optimistic, and there are some other reasons as well. And so we're reasonably comfortable maintaining a modest overweight because we understand why it's there. And that's the point that Bullish made, that the money is waiting to go into stuff that takes time to invest.
Okay, so Roy.
Thank you, Chair. On equities, when you're talking about income and growth equities, are you particularly targeting those products for that purpose, or is it by chance how they're defined? I mean, to my mind, a lot of income generating equities are good growth prospects as well. I'm just curious about how you decide what you go into in that sense.
I think I think I may have confused things a little in the way I've termed it. So we have 3 buckets, and we've classed listed equity, targeted return funds, and private equity as our growth assets. And I think that might have confused it. Listed equity will have equities within there which are more growth, i.e. pay very little income, and pay, on growth type traditional assets. So we've got a mixture of those, and how we've decided that mixture through a number of mandates that we have under those, i.e. we have legal and general passives, which is one of our bigger holdings, and we've got 3 mandates with LGPS Central. And that the makeup of that mix was via a listed equity review, which we completed about a year or so ago, which defined what percentages of that 37.5 we should have split across those mandates.
Okay, so thanks for all the questions. If there are other questions, there's some good questions there. We're asked to note this report. Is that agreed? Yeah, thank you. So we're on to agenda item 7, which is a review of the last year LGPS protection asset portfolio. Bullish is going to introduce the item, and then Mr. Philip Pearson is going to do a presentation on this. So, Bullish, I would you to introduce the item.
Thank you. I'll be a bit briefer on this one. We've got a lovely presentation lined up, so Philip will carry on from midway through his paper. So the purpose is to update the subcommittee on respect of a planned review of the fund's protection assets as agreed at the January 2024 meeting of the local pension committee. The strategic asset allocation for protection assets was held at 8% of total fund assets whilst awaiting the outcome of this review. The scope of the review was agreed with fund officers with consultation with Hymans. It's included within this paper at point 8, and we will go through those. A little bit of background at that table in point 5, what makes up our fund's protection assets. In the main, it's those 3, for the first 3 mandates we have there. So index-linked bonds, 240 million, it's at nearly 4% of total allocation. Short-dated corporate bonds, 60 million, 1% of total allocation. And investment-grade bonds with LGPS Central making up about 2.5% of total allocation. The protection assets allocation has remained at 8% for a number of years now. And the main changes have been adjustments between the mandates listed in that table on the previous page and agreed by the subcommittee in July 2023. The changes were a decrease from index-linked bonds from 4.5 to 3.5, an increase in investment-grade credit and short-dated corporate bonds from 2.75 to 3.75. Those changes were awaiting Hyman's advising on when the appropriate time would be to switch from index-linked bonds to investment-grade credit, and that decision hasn't taken place yet and is addressed later in today's paper. Point 8 looks at the scope. The scope is fairly detailed and was completed earlier this year, well, straight after the January 2024 local pension committee meeting. I won't read out points A to G. but it's fairly comprehensive. We weren't prejudging where this this review would get to, so you'll see some points in there may not be relevant by the time we got to the proposal and recommendation, if that's what we want to call it. 11 to 36 cover the main elements of that scope, but I think this is probably a good time to switch over to our presentation, which is included within the pack. And Philip.
So we're now going to have a presentation from Philip. I think you've actually got the presentation on your laptop. So
Are you doing it?
No, I'll go, sorry.
And the link. So you have got all the slides and everything on your laptop. So it's probably easy to follow if you look on that.
Given that, Chair, should I make a start with
Yes, please.
the
Yeah, that's right,
preamble?
Philip. Yeah, please do.
The slides need to catch up by about slide 3. So
Okay.
so it was kind of bullish to describe this presentation as a lovely one. It's not the most exciting investment presentation that the committee is going to see. But I can promise you we've done an enormous amount of modelling to kick the tyres on this issue and satisfy ourselves that the answer is correct. And I'm very keen to share at least some of that modelling with you. Starting with the background on slide 2, and in particular the market context. So two important things here. One, the fund is obviously in a stronger funding position, and 2, there has been a sharp rise in interest rates and long-term yields, which raises the possibility of increasing the allocation to protection assets that benefit from that sort of environment. And indeed, some would say, surely that's what the fund should do. It's obvious. And we set out to test that. Now, we did look at this briefly in the review last summer. We did some simplified modelling, which suggested that an increase in protection assets might improve outcomes, although the impacts were pretty marginal. That modelling had some limitations, and in particular, it focused just on the asset side of the balance sheet. And it didn't consider the interaction between the assets and the liabilities and the markets in which we're investing. And to address that limitation, what we've done over the last couple of months is a full asset liability modelling exercise on the fund. That is the best analysis that we can do to answer this question. Bullish mentioned the set of questions that we sought to ask, and they're on the bottom of slide 2 now. The most important one, which I will focus on, is should the fund increase its allocation to those protection assets? Turning over to slide 3, I just wanted to share the key conclusions, the punchline. Before I do, I would say that sometimes in investment management it is better to sit tight. And I'll share an anecdote, if I may, with the committee, going back to my days at Aviva Investors, where our performance and risk team discovered that the performance of some managers' portfolios was better when they were on holiday and when they were not over trading, buying and selling stocks. And I do remember that, because sometimes the right thing to do is nothing. And that is essentially what we're saying in this case. We don't think there's a compelling case to increase the allocation. The results I'll describe show that an increased allocation might improve some measures of funding outcomes, but only marginally. And it would lead to worse outcomes against other measures. So swings and roundabouts. We do believe that the fund is better protected by maintaining the current allocations to protection assets, and therefore the current allocation to return-seeking growth and income assets. So with the returns off those sorts of assets plus a reasonable level of contributions, to build up and maintain a healthy funding position. And that, we think, is a better way of protecting the fund against the bad things that could happen going forward. Having said that, you'll see that the modelling results are not clear-cut enough to absolutely rule out an increase in protection assets. So if there was another qualitative reason why you would want to do so, that would be perfectly possible. We've considered several possible reasons, but on balance, we don't think any are applicable to the fund. And I'll run through those reasons, and please do say if you disagree with our view on applicability. Before going into the results, I'll just share with you the other conclusions that we've drawn. So top of page 4, no, sorry, middle of page 4. We've looked at the impact on contribution rates. So increasing the protection assets wouldn't prevent you going ahead with a modest reduction in contribution rates, but equally increasing the protection assets wouldn't materially contribute to the stability of contribution rates going forward. So there isn't a strong contribution rate reason to either increase the protection assets or not to. We looked at whether the fund should invest in alternative protection assets. And two in particular we focused on: gold and senior debt secured against real assets like property or infrastructure. Gold was interesting. It's got a long-term link to inflation. It performs well, or can perform well, in crisis situations. But the returns are highly volatile, and the asset class can have very long periods of underperformance. So we think it may well be worth considering gold, but only if the allocation to protection assets is increased to allow you to make a big enough allocation to gold for it to make a meaningful difference in the event of a crisis. And I'm sort of talking, 5 to 10% allocation. And clearly that's not possible within a protection asset allocation if it stays at only 8%. And the reason for that is, you'd want it to be big enough to make a difference in a crisis, and you'd want it to be big enough to justify the additional government's burden of bringing yet another asset class into the fund. So we're holding that still as a possibility. Real asset-backed senior debts, we thought it might help, particularly at times of high inflation and rising rates, and from a downside protection point of view. The answer is it wouldn't do any harm, but it really wouldn't materially improve things. So again, from a governance and complexity point of view, why bother? Within the existing range of assets, we think the strategic asset allocation is fine. You're currently a bit overweight index-linked gilts, underweight corporate bonds, and that you should rebalance that. But going back to the sort of tactical views on markets that I mentioned earlier in the context of equities, we still don't think the tactical outlook is right to go ahead and rebalance, because it would involve selling index-linked gilts that we have a positive view on and buying investment grade credit that we are mildly cautious on still. We looked at whether protection assets would help in the context of climate change, and the answer is yes. They might be more resilient in certain climate change scenarios, but for reasons which I'll go through when we get there, we don't believe that the improvement is sufficient to justify increasing protection assets solely for the reasons of climate change. So that's it in terms of conclusions. I did just want to share with you some of the results of the modelling that we've done to back up those conclusions, and particularly the ones around the key question of increasing the protection assets and also the impact on contribution rates. Before I do, though, I thought I'd better give you a bit of a refresher on this asset liability modelling stuff that we do, because it is fairly obscure and very heavily numbers based. So if you would indulge me with 5 minutes of patience to go through the modelling approach. So what we're trying to do here is to predict how the fund might perform over the very long term. 17 years is the horizon we choose. And performance, the key measure of performance is obviously where the funding position might get to over that period of time. Now, the challenge here is it's impossible to predict what economies and markets are going to do precisely over 17 years, so we don't try. Instead, what we do is we consider a very large number of scenarios, 5,000 different scenarios, each envisaging a particular path for economies and the markets in which you invest in. And taking each scenario, we model how the fund would perform if that's what happened. And we measure the funding position at the end of that 17-year period or at different points in the intervening period. And then we do that for all 5,000 scenarios, and we generate a distribution of outcomes for the funding position, which is sort of shown diagrammatically on the right-hand side of that chart. Some of the outcomes are extremely good, very healthy surplus. Some of the outcomes are pretty dreadful, quite a severe deficit, and there's everything in between. It's a very complicated distribution, so what we generally do is focus on a small number of key metrics. And on the next slide, slide 10, I've defined the ones that we use with you guys. Sorry, slide 10. There are 4 key metrics. The first is the probability of success, which is the proportion of those 5,000 scenarios where the fund ends that 17-year period being fully funded, a funding position of 100% or better. The second is the downside funding level. So this is the average funding level in the worst 5% of outcomes, and is a measure of risk in normal market circumstances. So it's a measure of the outcomes that you get in the bottom part of that, the bottom block in that distribution on the left-hand side. We also look at the tail risk, which is a similar measure. It's the average funding level in the worst 1% of scenarios, so 1 in 100-year type events. And then finally, to avoid being completely gloomy, we have a measure of upside, a prudent measure of upside, which is the median funding level, which is the funding level that you might expect to get to half the time if markets do well, and crucially, if no action is taken on contribution rates. So we're assuming here that the current very high level rate of fairly high rate of contribution rates continues for forever. So that's a measure of upside potential. Let me just pause there and make sure everybody's comfortable with scenarios and what those metrics might mean.
So, has anybody got any queries or questions so far? No? Okay, thanks, Philip.
In which case, let me continue. Moving over to the results, but let's just pause on slide 13, which is just a reminder of why we invest in protection assets. So two key reasons. Firstly is, believe it or not, they do reduce investment risk. And we say that because there is a very high likelihood of getting your principal repaid on the debt. Protection assets are mostly debt, and receiving the income that you're due. As you saw last year and the year before, protection assets are subject to market volatility, and over the short term their value can fluctuate significantly. But they do tend to fluctuate in line with the value of the liabilities. So in a sense, they're matching what happens to the value of the liabilities. I'm not going to say a hedge because they're not a perfect hedge, but they are sort of matching, and by doing so, they help to protect the funding position. So those are the two reasons why we invest in these things. The other thing to say at this point is that it's not just the protection assets that protect the fund. So most of the asset classes that you invest in do play a role in risk management. So equities, for example, are not bad at protecting you over the long term, 5+ years, against rising inflation. Don't really help in the short term, but over the long term, they're not bad from a risk protection perspective. So yeah, just when you're looking at these results, bear in mind that it's not just the 8% of protection assets that are protecting you. There's lots of other stuff that's helping as well. So let's turn to some results, and slide 16 is the one that I wanted to focus on, because this focuses on the key question of should we increase the allocation to protection assets. And the way we tried to answer that was to look at the how the current strategy might perform, and how a strategy where you increase the protection assets by 10% and also by 20% might perform across those 5,000 different scenarios. And in the little chart and the table underneath it, we've plotted the results of those metrics: the probability of success, the little pink diamonds, the downside funding level, the blue bars, and in the table below, the upside potential, the median funding level in 17 years' time. And you'll see that the current strategy has pretty good metrics: 94% probability of success, a downside funding level of 77%. In other words, the possibility of a 23% deficit opening up, and also a really good median funding level, 240%. Now, obviously, that wouldn't happen because some action would have been taken on contribution rates before then. But if you left everything unchanged, that's what would happen in 50% of the time on a 17-year view with the current strategy. So these are strong funding metrics, and straight away they're saying, be wary about changing the current strategy because it doesn't look bad. If we did increase the protection assets by 20%, so focusing on the right-hand set of results there, you do see some improved outcomes, but they're only marginal. The probability of success goes up a whisker. Those numbers are rounded. The whisker is well less than 1%. The downside funding level goes up to 81%, so 4 percentage points better. Yeah, it's better, but not a lot better. And the reason for that is that the benefits that these extra 20% of protection assets bring are offset by the fact that over the long term, you would expect those assets to generate lower returns than the stuff that you would have sold to buy them, the equities, the real assets. Also because those other assets, the things that you sold, would have been protecting you against some of those risks like inflation. And then finally, because protection assets themselves aren't risk-free, they're volatile. So in certain circumstances, they don't hedge the liabilities perfectly, and they can contribute to worse funding outcomes. So those are the reasons: improved outcomes, but only marginally so. And if we focus at the table on the bottom right-hand side, on the bottom of the chart, a 20% increase in protection assets would lead to a 25-point reduction in the median funding level. So less upside potential, less chance of building up a strong surplus. So a marginal call here, and there's one key assumption underpinning all this, and that is a constant valuation basis. And by that I mean the rate that you use to discount the value of all those liabilities you have stretching far into the future to calculate a single present value for those liabilities today. We've assumed that if we made a 20% increase in protection assets, that discount rate and the value of those liabilities would stay the same. That is unlikely. More likely is that the discount rate would fall because the expected return on the assets that you were left with would be lower. And if the discount rate falls, the value of the liabilities goes up, the funding position comes down. Very roughly, we estimate that a 20% increase in protection assets would lead to a 9-point reduction in the current funding level, and probably therefore the funding level at the 17-year point as well, which would neutralize some or possibly even all of those marginal improvements that you saw in the chart on the left-hand side of the table. So increasing the protection assets probably would have a modest improvement in some funding metrics, not all, and it would be super marginal. We just don't think it's a strong enough case to move away from the current strategy, particularly given the predicted funding outcomes of the current strategy are so good. We've done a bit more modelling, so I'll run through that, but a bit quicker. If we could go to slide 18. Obviously, the results I've already presented consider all 5,000 scenarios. We then asked ourselves the question, well, what happens if specific circumstances arose? Would it, in those circumstances, would it make more sense to have more protection assets in the portfolio? And the way we've done that is by filtering out a subset of those 5,000 scenarios where certain bad things happen. And the sort of bad things that we've considered are very low equity returns, very low real yields, very high inflation, very poor outcomes in terms of total scheme assets. And we've tabulated how the probability of success would change if those particular types of scenario happened for the current strategy and for the two alternatives where we increase the protection assets. And those results are tabulated in the table on the slide. So, for example, with the current strategy, if inflation was just under 5% every year for the next 17 years, which historically would be a dreadful outcome, even historically looking back over the late 70s, early 80s. What would happen? Well, the probability of success with the current strategy would fall from 94 to 92%. Hardly a dreadful outcome. And it wouldn't be particularly different with more protection assets. So no obvious reason to change for that reason. The only set of circumstances that could justify an increase in protection assets is a very, very long period of very disappointing returns from equities. And there you can see that the probability of success would fall to 62% with the current strategy, and 70% with a strategy with much more protection assets. So that's a specific set of circumstances that might justify it. Now, as a general rule, we don't recommend designing strategies for specific sets of circumstances because we don't believe that we or anyone else can predict what's going to happen over 17 years. But if you felt that equity markets were going to perform really badly for the 17 years, which we don't, by the way, then that could justify an increase in protection assets. Bottom line, though, is we don't know, is the first point. Secondly, we have no strong reason to believe that equity markets are going to seriously underperform over that time frame. So again, we just don't think this is strong enough evidence to go ahead and change the protection asset mix. We shouldn't just rely on modelling, and everything that I've talked about so far is modelling results. So the other thing we asked ourselves is, are there any qualitative reasons why you might want to increase the protection assets? And on the next two slides, we've looked at 4 possible reasons. The first is you don't believe the model. You think the assumptions or the way we've done the projections are wrong. And you have a gut feeling that protection assets are good. So, so that's what you should, so we should increase them. One should be wary of models, absolutely. But we don't think that's applicable in this situation because this is a model that has been very carefully calibrated against a very long history, which has included periods of great performance from asset markets and periods of dreadful performance, and the distribution of outcomes that you've been looking at some of the results of include the full spectrum of scenarios. The second reason why you might want to change is if your risk appetite has changed, and in particular if you've got more risk averse. So going back to those those earlier results, if you've got more risk averse, you might be willing to trade that 25% point reduction in median funding level to trade that benefit for a 4% reduction in downside risk. We're not aware that the fund's risk appetite has changed. We're not aware of any reasons why it would have. So again, we're not convinced that this is a good enough qualitative reason to make a change. The third reason why you might go ahead and do it on the next slide is tactical opportunity. Gilts are much cheaper than they were. They're cheaper than we assess to be fair value. The price is likely, but by no means certain, to go up in the next year or two. So you could take the view, we just buy them now cheap and sell them when they're a bit more expensive in a year's time. That would be a perfectly legitimate investment reason for buying them, but it's a tactical trade, and we We understand that that's not something that the fund wants to do, and we completely understand why. You leave that sort of thing to your managers. So again, we don't think this is a good enough reason to go ahead and do it. Finally, climate change. This is the one which we felt had most legs in terms of a qualitative reason for contemplating a change. And the reason is that protection assets, particularly the sovereign debt, the gilts, may well be more resilient in certain downside climate scenarios, particularly, existential ones where financial markets collapse, and you hope that the UK sovereign is still functioning and still paying its debt. So in those sorts of circumstances, it might be handy to have more protection assets. And in that sense, we thought this did have some potential mileage. On balance, though, we're not using it to recommend a change in strategy, and there are a number of reasons for it. Firstly, by investing in senior debt, and particularly in sovereign debt, you're getting less direct exposure to climate opportunities, those decarbonisation technologies that the world needs and in principle can provide good returns for the fund. You've rightly said that you wanted to strike a balance between reducing your climate risk exposure, but also profiting from the investment opportunities that decarbonisation will bring. So that's a bit of a concern. Secondly, buying senior debt, you have less scope in terms of engagement with the underlying companies and businesses and activities. And again, you said you wanted to strike a balance between engaging with companies to actually improve the position on climate change as opposed to simply selling them, which is what you'd have to do in order to buy more protection assets. So again, not convinced that's a strong qualitative reason. Second reason is that we believe that the action that you've already taken, where you've been able to take it, so for example, investing in the low carbon transition index fund through the equity review, investing in the Quinbrook net zero power fund in infrastructure, and other similar actions that you will be able to take on private markets going forward are currently sufficient to hit your net zero goals. So, in a sense, you don't need to do more at this stage. And then the final reason for not using this as a reason for argument for going ahead with an increase in the allocation is that those modelling results that we saw before include a whole lot of scenarios that are characteristic of what we think might happen if climate change had bad outcomes. And, you saw that in some of those scenarios, the downside is not good. Funding level falling to 77%, that's clearly not a great outcome, but it's by no means a disastrous outcome. So again, we're not convinced that on its own this is a good enough reason for increasing the protection assets. So that's it in terms of the headline question. I want to say a few more words on the interaction with contribution rates, let me just say those few words and then I'll throw it open to questions because I'm almost there really. So slide 25 is the one that, thank you, that highlights the results. So what we've done here is a very similar analysis to the results that I presented first thing, but instead we've reduced the contribution rates to 21% from the current average of 27%. And plotted the probability of success and the downside funding level. And what you can see is that, well, there's a couple of important observations here. One is that the probability of success falls a bit, but only a bit, to 92%. And that's still well above your prudence threshold. So still very, very strong metrics. The second thing is that the downside funding level is also a bit worse. I haven't got down here how much it's worse, but it is a few points worse. And as we saw before, there's a small difference between the different strategies we've modelled. So 70% for the current strategy, 75% if you were to increase the protection assets by 20%. So two things that we draw from this. Firstly, if you were to increase the protection assets by 10 or 20%, it wouldn't stop you reducing the contribution rates to around 21% because the metrics are still very healthy. Second, if you thought about increasing the protection assets in order to reduce the risk of deficits opening up in the future, which would, all other things being equal, and those deficits were sustained, would mean a future rise in contribution rates. And the answer is that increasing the protection assets doesn't dramatically reduce the deficit that might open up. So on that analysis, it's a 25% deficit that would open up, even if you did have 20% more protection assets. So it's not materially helping in terms of improving the stability, the risk of deficits opening up, and thereby improving the stability of contribution rates going forward. So again, not convinced. It's a good enough argument to go ahead. Think you should sit tight. And that's really the headline conclusion, as I mentioned at the beginning. Just circling back to slide 6 for the recommendations. They are what you'd expect from the results I've presented. We do, well, assuming that you agree that none of those qualitative reasons are in themselves a good enough rationale to increase, we recommend you sit tight and maintain the current allocation to protection assets. And then the third bullet point is you do still need to rebalance the protection portfolio to the target allocations that we agreed last year. We don't think the market conditions are still right to do that. We will tell you when they are. That's it. Those are the recommendations.
Okay, thanks very much, Philip. Certainly massive modelling done on real case scenarios as well, going back over the years. Yeah, that's interesting. So, has anybody got any comments or queries? Yeah, Roy.
Yeah, thank you, Chair. Very comprehensive and very informative. I commend you on the exercise you've done. The one area of sensitivity that you didn't touch on is the global political and armed forces are active, aren't they, everywhere? You mentioned gold, and China's buying gold going out like there's no tomorrow, which suggests Taiwan might be a problem in the near future. Has that element been built into it in any way? Presumably it has in some fashion.
In some fashion, yes, absolutely. So I will confess we don't know what's going to happen in Taiwan, and we certainly haven't modelled it. But what we have done in calibrating those 5,000 scenarios is consider historic events, which are characteristic of the sort of things that might happen if China was to invade Taiwan. I'm not sure whether our calibration goes quite as far back as the First World War, but it did all happen in Bosnia, didn't it? It all kicked off in Bosnia, I think, if I remember rightly, Sarajevo or Serbia. So we have, we have calibrated against historic events, which reasonably could be indicative of the sort of things that could happen in a place like Taiwan if China were to invade. With, I would say, one huge caveat. All our modelling and all the calibration we've done does assume that society and economies continue to function and capital markets continue to operate, not necessarily normally, but they do continue to operate. And one can consider scenarios which are more extreme than that. It's just we don't think we can do it within the constraints of any financial modelling. And I suppose it's those sorts of things where something like gold would arguably come into its own. In the case of China and Taiwan, I don't actually think that's the reason China's buying the gold. The main reason I've understand China buying the gold is that they want to diversify their sovereign reserves away from US treasuries. So at one point, I think they held something like 3 trillion of US treasuries, which seems unwise given the deterioration in relationships between those two countries. But yeah, fair challenge.
Yeah, thanks for it. Going on from that, then it's how do you define protection? A lot of the equities you've got are protective in their nature. So I don't quite know where you draw that line and whether the word protection assets is actually reflecting the difference between what is and isn't what you class as protective.
It's a helpful simplification, but it is a huge simplification. That growth, income, and protection stuff, those terms, they are far from ideal. In fact, one of my other clients refuses to use the word protection, and they ask us to use defensive assets instead. But you're absolutely right. Most of the other assets in the portfolio protect against certain risks. It's not just protection assets. The way we decide what to put in that bucket and the things to consider is more based on the function, if you will, and the characteristics of the assets themselves. So we consider things in that bucket where they have a risk of fundamental loss, i.e. just not getting your money back, that is very low, and where you would expect their value to fluctuate in line with the market. And that's why we put things like the gilts and high-grade corporate bonds and gold. Gold meets that criteria. You can always sell gold and get your money back. It's got huge market volatility. The gold price fluctuates all over the place. It does tend to fluctuate in line with the liabilities, but not that well. So it just about creeps into the protection bucket, but only just.
Thank you, Roy. Zubair, yeah.
A couple of points, please. You might know the answer or not, but has the fund always had an 8% allocation towards protection? I think the reason for asking is, if it wasn't, then when was it last amended, and what triggered that off at that stage, and why is it not relevant, or is that irrelevant to us at this stage? I just don't know the history of if we've always had 8%.
I can go back and have a look and see when we last made the change and get back to you on that. But since I've been here for the last 4 odd years, I think we've been at 7.5%, 8%.
I would be surprised if it had been higher, because generally LGPS funds were much more heavily invested in equities, and have been selling their equities rather than selling their protection assets. I might, sorry, Chair, for interrupting there, but I might just throw in at this point some comparison with other funds. So which sort of might help on the same points. So what we are seeing across the LGPS funds that are in a similar position to you, i.e. fairly well but not fantastically funded, reasonable cash flow position, reasonable amount of risk appetite, but not pushing the boundary on risk by any means. We are seeing asset allocations heading down to 40-45%, equities 25, maybe even up to 30% income assets, and 10 to 15% protection. Hopefully that all adds up to 100. I'm not sure it does actually. What have I missed? 40, 45. I'm missing 10%. So probably 10 to 20% protection. So you're on the low side, admittedly, protection. Must be a bit more in income, because I know equities is 40 to 45, maybe as high as 50. So that's the sort of ballpark. So you're I suppose what I'm saying there is that you are already at the lower end of protection assets relative to other funds, but crucially you're already at the lower end of growth assets. And the reason you're at the low end of growth assets is because you've made more progress on investing in income assets than a lot of other funds, mainly because you started a bit earlier.
Okay, thanks very much. I mean, simplistically, I suppose, without trying to counter anything that Roy was saying about, scenarios like China and Taiwan, the market itself will price in, I appreciate these, will price in risks like that. The global markets will price in risks like that, will they?
They should do. Every single investment conference that you go to now has a slot on geopolitical risk. Taiwan, there's a lot of work going on to try and understand what Xi Jinping means when he talks about Taiwan coming back into the fold by 2027, whatever the latest pronouncement is. People are looking at this stuff really closely. And to the extent that they are able to draw any conclusions, that is very likely to be priced into equity markets in particular.
Thank you, Philip. Is there any other questions? Zubair?
I had a question about, you mentioned about the modelling, and it's quite complicated, etc. From a governance perspective, it'd be useful just to understand from the fund's perspective, because we rely heavily on the modelling to inform significant decisions, what sort of quality assurance or other takes place within the funds to ensure the integrity of your modelling? Because we've got no control over these things, but we take decisions on those. So just useful to understand that from a governance perspective, maybe not for this meeting possibly, but just asking that question. And along the lines of governance as well, I think you mentioned about gold, you mentioned governance issues around gold. I think there'll be a whole discussion about ethical, stance around gold itself. So I just wanted to mention those 2 points.
Both very good points. We do have some material that we could supply afterwards around model governance, and the answer is that we're very careful. So, for example, there is a committee that approves each and every new assumption that's made within the model, and a lot of work has to be done before any change is made. So we can supply stuff on that. It's a very, very good point.
Okay, Adam.
Yeah, you've obviously talked about kind of historic events being kind of a way of kind of gauging decision making. I'm interested in the conversations that are happening around China, Taiwan, etc., etc. But I'm interested in to what degree climate risk as a threat multiplier is part of the vocab or the discourse kind of amongst your peers, I suppose. So obviously you look at historic events where you didn't have climate risk, but now we have climate risk and it is recognised by the United Nations as a threat multiplier, so we're more likely to get globally significant events which will have an impact on markets. Is that something that is within the discourse? You get a drought, you're more likely to have war, it's more likely to affect the markets.
Yes, it is. I mean, I think when we're setting assumptions and when we're thinking about which sets of scenarios best describe the range of things that could happen in bad outcomes for climate change, we are very conscious of those interdependencies and multiplier effects. And as a result, I think we've been fairly conservative in terms of selecting the scenarios that represent what could happen with climate change. And I'm reassured by that. What I don't think I don't think we can claim we do is explicitly model all those interdependencies and how they might play out. And that's because of the way in which we've calibrated the models, which is against historical experience, including very bad historical experience. But that is different from modelling a specific set of scenarios and of interdependencies between different economic and natural processes. So what I always say, and hopefully I did remember to say it here, is that it is possible to envisage scenarios that are worse than any of the ones that we've considered in that 5,000, and particularly scenarios where perhaps you get a lot of multipliers, where drought does lead to war, where war leads to the collapse of societies and the the collapse of financial markets. We haven't modelled that because we can't, but it could happen. And if it did happen, you know, the fund would be in a difficult position. There's no doubt about it. The question is what you do about it today, because there are a handful of assets that would really help you in that case, and those are, you know, gold, possibly industrial metals if there was any industry left to use them. None of those assets generate an income in their own right. So while you're waiting for Armageddon to happen, you've got no income coming in to pay the pensions. So it's not cheery, but it just highlights the difficulty of there are a few things that could help you in really bad outcomes, but they absolutely don't help you in the meantime.
I'm not necessarily thinking about the really bad outcomes. I'm just thinking about the kind of increased volatility as to what we've had previously because climate change is genuinely recognised it is going to create more events that will create volatility within markets, and therefore the need to protect becomes greater. And so I'm just intellectually interested actually in kind of what you and your peers, how you and your peers are verbalising some of this stuff.
I think, volatility, I think, looking at the downside scenarios we pick out to represent different climate change outcomes, they are characterised by extremely high volatility. So I think we've got that fairly well captured.
Okay, thanks very much. So, to add to that, we also have the MSCI climate scenario analysis, which is every
the Mercer analysis.
Sorry.
But that was through Central, so we're not sure what the next step with that is. But I know Hyman's are considering it as part of the triennial valuation, which would hopefully get a more updated view.
Point is, they do that scenario analysis of with the strategy we've got, what does it look like? The different events, does the world sort of transition sensibly to net zero, or does it get behind, etc. And it does show that kind of the strategy works if we do go that sort of sensible sort of route. But if the world gets sort of a tardy sort of transition, that really does impact the fund quite badly. So, which is why I suppose we can justify the fund having a strategy to sort of contribute towards net zero and make that transition, because that's seen as the best outcome. But as Philip says, if the world goes to hell in a handbasket, it's very hard to do anything about it.
Okay, so just Roy, I'll come to you in a minute. Just Dan.
Yeah, so just from to say that's a very, very, very well explained report. Actually, that was good explanations on the papers that came out to us, and added to, obviously, if we do get to Armageddon situation, perhaps we'll probably won't many people around to be drawing the pensions. But we do need to have that risk element in, which we have in the model is for.
Thanks very much. So, Roy, nothing more depressing, Roy. We need some upbeat stuff now.
No, I want to keep that side going, essentially the context we've been talking about. Not really. I mean, you just mentioned that the biggest climate change problem we might face is flooding of places like London and New York, because most major cities are on the edge of the ocean. But the point I was going to try and make was to go back to your benchmarking. You benchmark against, you consider yourself against a benchmark. You don't consider yourself against other funds. I can understand if you've got a benchmark and you're not exceeding in any great mark, you can go to passive funds. But I do think there's some measure of benefit from looking at other funds, see how they're doing, because that will reflect on what we think about the people who are doing this for us and which funds, which managers we should have involved.
I mean, we touched on, I suppose, the difficult, and even within our own sort of central pool, where you get a bit close to seeing what other people's asset allocations are like, you do see that big divergence between people who've got really far ahead on sort of the funding, sort of really switching the sort of the allocation into bonds and things like that. So it does create that distortion. But every 3 years off the back of the validation, the government's actuarial department does a report called Section 13 report, I think it's called, and that does try and equalise the different assumptions, because you've got quite a few factors. You've got how much the employers are putting in terms of kind of those sort of payroll related kind of deductions. You've got the sort of the funding risk level, sort of etc. So it does try and bring it together and equalise it, and sort of shows where we are on that sort of funded basis that sort of equalise it. And we kind of, but I suppose it boils down to what's the funding position of the fund as opposed to necessarily the performance on an individual assets, because they're so mixed, and that's hence why the benchmarks come in. But if you just look at that funding overall performance, we are kind of in the bottom half, which is why we've got quite expensive employer contributions at the moment. But hopefully, as people kind of get to the top, de-risk the sort of the schemes a little bit, that starts to equalise a little bit. But the GAV 13s probably want to have that discussion next time that comes out, because it does try and sort of just equalise a lot of the different factors and see on that sort of total funded basis how we're comparing to different sort of funds.
Okay, so if there are no other questions, then we're asked to note the report, and also the recommendation is that we, from our advisors, that we maintain the allocation for reduction assets as they are at the moment, and information requested in the meeting is to be circulated by email. Is that agreed? Right, that's unanimous. Thanks very much. The date of the next meeting is the 24th of July 2024 at 10 a.m. There are no urgent items, so that brings the meeting to an end, and the live stream will now end. So thank you all for your questions today. Some very in-depth questions, some very depressing situations as well. So I was feeling quite cheerful before I came here this morning. But yeah, we certainly consider all the risks. Thanks very much, everybody, and we'll see you on the 24th of July.